All right, guys, I'm going to bring up Nick from MB Capital. He's a owner and operator of MB Capital, and he's going to talk to you guys tonight about building your credit on your business and as well as getting unsecured lines of credit for that business. Let's bring up Nick. Here we go, guys.
So, quick show of hands before I get started. How many people in this room has ever missed out on an opportunity, didn't put an offer in because they had lack of access to capital? Raise your hand. And how many people, if you had an additional $50,000, $100,000, $150,000, could take advantage of more opportunities, do more deals, get into more properties? No shit, right? That's a no-brainer. So tonight what we're going to talk about is building up your funding toolbox, making sure that you always have access to capital so you can get out there, do more deals, and essentially create more wealth for ourselves so we don't have to work as hard, create passive income. But at the end of the day, we all need access to capital to do more and more deals. And then just a disclaimer before I kind of jump into the presentation here. I am Italian. I have very dago arms. So if you see me flailing all over the place, I'm okay. It's just, you know, I'm Italian and I'm very expressive with my hands. So let's dive into it. So what we're going to talk about today, I'm going to go over a little bit more about who I am, who MB Capital is, what we do for our clients, how we like to start to position our real estate investors. We're going to start talking about the funding toolbox. So the funding toolbox is a concept that I kind of go over with all clients. We all have a funding toolbox. What's in it? Do you even know what's in your funding toolbox? Are you missing out on deals because you don't realize you have access to capital that you really don't know is there? So we're going to go over the different types of tools that are in our toolbox and start to position you so that you have access to all those tools, can do more deals, like I said, and take advantage of more opportunities. We're going to go over specifically unsecured funding. Their uses, how we get them. MB Capital Solutions specializes in unsecured funding. In a nutshell, unsecured funding is leveraging our personal credit to acquire a line of credit in the business name that we could use for any general working capital purpose. So as real estate investors, we can use it for down payment money, combine it with alpha, go out there and do more deals and hold on to our cash. Alpha is going to give you 80, 100. You need that 20% down payment and closing cost, leverage the line of credit, keep our cash in our pocket, and essentially we're 100% funding a deal. Go use the crap out of the money. The money reports in the business name. Even though we leverage personal credit, funds are issued in the business name. Like I said, use the money. It doesn't report back onto your personal credit. Keeps you bankable, lendable. If you're doing buy and holds, it keeps you in a position to always make sure that you can get refis, or just if you need to acquire more capital, it keeps personal credit clean. I myself am a real estate investor. Currently, I'm using almost $250,000 all leveraged on lines of credit. I've built up a good amount of access in the business. None of that reports on my personal credit. So whenever I do my refi on the back end of my BRRRR model, I don't have an issue with refis. Moving forward, it's all about positioning, making sure we have access so that we can do more deals, like I said. And then we'll end with some, Q&A. I always get a lot of questions. There's a lot of different types of business funding out there. There's a lot of misconceptions. So if you have any questions, let's hold them to the end. We're going to have the mic go around, and we'll make sure that we answer all your questions before we're done tonight. That handsome gentleman is me, Nick DiFederico, MB Capital Solutions, a lead funding strategist. I'm a serial entrepreneur. Since I graduated from high school, I've been an entrepreneur. So 2 days after graduating high school, I had my mortgage brokerage license in hand, ready to conquer the world, or at least at 18, I thought I was gonna. While I was in high school, I was working for a couple guys that were in the mortgage business. This is 2004, and they were killing it. And they were probably two of the dumbest people you've ever met in your life.
Hey.
Not you, it's not you.
I was just asking.
These guys were schmucks. If you look up schmucks, these two guys are right there. So I figured if I can get my license, I could do it just as well. Back in 2004, much different climate. To get a mortgage brokerage license, I needed two things. I needed to be 18, check. I needed a clean fingerprint, check, got my license. And people wonder why there was a mortgage collapse in 2008. So, it was a fun time for sure. When I went to open up my office, I went to my stepfather, who had a building in Northeast Philly. He had an empty second floor. So he said, I'll make a deal with you. I'll give you reduced rent. You got to manage my pawn shop on the first floor, right? It's nothing for free with that guy. Being 18, I said, let's do it. Fast forward to 2007, it ended up being a blessing in disguise because as I couldn't get anybody approved for mortgages anymore, I was in the right place, right time. Commodities with the recession took off. So your gold, silver, platinum, rare coins, diamonds, all spiked in value. And I was just, from working in the pawn shop, primed to understand how to take advantage of that opportunity. So I set out to open up a cash for gold store. I'm sure over the last 15 years, we've all seen the cash for gold signs, cash for silver signs. If you sold gold in South Jersey or Philly, I probably touched it at some point. And it was really when I met my now partner, Eric, that I was able to scale the business. I was using so much of my own cash in the business. My wife was freaking out. We weren't married at that point, but she's like, you say you're making money, but where's all the money? I'm putting it right back into the store. So when I was able to put in place a $100,000 line of credit through MB, I was really able to scale and grow. I ended up opening up 13 stores from Philly all the way down to the Jersey Shore. Ended up building that business to do about $18 million a year in annual revenue. So just by leveraging a couple lines of credit, you can see the power by turning it and flipping it, much like we do in real estate investing, how just having access to capital can help us grow our business. Fast forward to about 4 years ago, I was looking for a change. Climate and the economy was coming back. I still have my wholesale business in the jewelry end. And at that point, I was investing in real estate. So went back to Eric to get some additional lines of credit. And it just made sense that we partnered up and start to help other real estate investors get more capital. I myself, like I said, I'm a real estate investor. I focus on buy and holds in the Philly market. So if you know anybody who's looking to sell in Philly, you can send them my way. I'm happy to have a conversation with them. I do the Burr model. Anybody familiar with the Burr model? Perfect. I buy it, I rehab it, I get it rented out, I do my refi, pull all my money back out and do it over and over again. Essentially, I use none of my own cash. I leverage the lines of credit, I keep acquiring properties, and the goal is to get to 50 cash flowing properties so that then I'll focus on some more commercial, but the more passive income I can create, the better. It lets me not have to worry as much on monthly bills, raising 2 young kids. So the goal is to get to 50 and maybe go more commercial. So it's a little bit more about me. Who's MB Capital? So MB Capital was started by my partner, Eric Moz. Anybody in the room ever work with Eric? A couple of you should. Awesome. Eric started working for a company in 2009 while he was investing in real estate and learned more about unsecured funding. It was so powerful for him that he set out to start, showing other real estate investors, business owners, how to build capital to take advantage of opportunities. I being one of them. Like it says, we have an office in Sewell, New Jersey. Sewell is really South Jersey. I know there's a lot of debate about South Jersey. Sewell is South Jersey. That's right outside Philly. It's not, it's definitely South Jersey. We specialize in funding for small business owners and real estate investors. I would say 90% of our clients are real estate investors. That's cut off a little bit. There's a couple other things I'll touch base on. I would say 90% of our clients are real estate investors. The other 10, general business owners. But what I've learned is most real estate investors have some other business as well. So, we can get capital in multiple entities and be able to build up capital to be able to take advantage of more opportunities. How many people in here are Fortune Builder students? Raise a hand. Great. I work with Fortune Builder students all across the country. So not just John, but a lot of the Fortune Builders coaches we have good relationships with. They send us our clients so that we help get them capital. We're a little bit different than NCH, if you guys are familiar with NCH, where NCH is helping you build up business vendor lines and start to build up D&B score. We focus more on cash access. Having vendor lines are great, but if you don't have cash, how many properties can you buy? And can you buy a property with a gas card? No. So we work very well with NCH to combine both so that you build both at the same time. So I'm going to focus a little bit more on the cash access tonight and not so much the vendor lines. But if you have any questions about that, feel free to ask. I'm happy to give you a little bit more about that. The Funding Toolbox. You'll see a lot of our materials talk about the Funding Toolbox. And essentially, I create the Funding Toolbox as a way to kind of illustrate we all have options to be able to get more and more deals funded. When we meet with clients, one of the first things I ask them is, how are you funding your deals? And I'll hear a million different answers. But the thing that I found interesting that was most people are a creature of habit. So however you're currently funding your deal is typically how you think you have to fund every deal. So how many people use a little bit of cash and hard money to fund their deals? Do you use any other form of method to get into your deals? Great. This is a way to illustrate that, yeah, there's other options out there. If you combine them all, if you know they're there, when you have an opportunity pop up, you just come back to your funding toolbox to be able to fund it. So when we're talking about residential and commercial loans, Freedom Mortgage, if you need a residential loan or if you need a refi, they're here as a resource. I can't tell you how many clients that I've worked with where they've chosen to go residential route to get a mortgage to put 3% down because they could qualify for it. And then we got them a line of credit where they would use the line of credit as the rehab funds and essentially just flip the property that way. Commercial lending as well. Ideally what we want to start to do is start to acquire these properties in our business name so that they don't report back onto our personal credit and mess up our debt to income ratio. More importantly, when we're out there getting more funding, when lenders see that you have 8, 9, 10 properties, it becomes a nightmare when you're trying to go through underwriting. So when we have commercial lending, we can start to do a refi, do a cash out in the LLC name, have it off of our personal credit. All 9 of my properties are in the business name, all refied in the business name so that no issues pop up on my personal credit. Lines of credit. We're going to talk about lines of credit tonight, so I won't touch base on that. 401k and IRA. Who out here has rolled over a 401k and has a self-directed and uses it for real estate? Perfect. If you have an old 401k and it's just sitting there, you left a job, you don't realize that you could roll that over and leverage that in our real estate business. We can go put that to work. It doesn't need to just sit there and collect dust, so to speak. Let's leverage it to go do more properties. Hard money, alpha funding. Who here has used alpha funding? There should be way more hands. Alpha funding is awesome. And I'm not saying that because I'm vendor here with Matt. I work with a lot of clients all across the country. I hear horror stories about a lot of different hard money lenders. What I love about alpha is they're there all the time for you. More than anything, I like that they pull credit once a year. They approve you for your deals for a year. I don't think people realize how valuable that is, especially for me as I'm trying to get capital for clients and I'll see a hard money lender pull credit 4, 5, 6 times before they do the first deal. It prohibits us from being able to go get them funding because the hard money lender, through the course of their underwriting process, has pulled credit so many times. Working with Alpha, we refer a lot of clients back and forth to each other. They're one of the best, honestly. I wish they did more states because I could put more business with them. If they could do Colorado, that would be great because I just can't find a good hard money lender in Colorado. I do a lot of webinars for Fortune Builders classes in Colorado. So Matt, Colorado. Credit cards. Who here has ever used a credit card to go buy a property? Nobody's used a credit card to go buy a property. That's crazy. It's an underutilized source to be able to go out there and get funding. So the first question you're asking is, how do I swipe a credit card to go buy a property, correct? There are ways to liquidate a credit card into cash, be able to put it into your bank account, use it as working capital, and go close on a property. We also work with a third-party company that if you have an agreement of sale, they'll run the contract as an invoice, wire funds directly off of a credit card to the title company so you could show up and literally close on a property leveraging a credit card. Now, why would we want to do that? Well, the 0% interest rates make it a no-brainer. So think about needing 20% to go put down on your alpha loan, and you pull that off of a credit card and carry that debt from anywhere from a year to 2 years at 0% interest. It's a game changer. We do a lot of 0% credit card plans for clients, especially with the newer LLCs, so that they can get out there and get into a deal where otherwise they couldn't because they have lack of capital. The fact that only one person has used credit cards is pretty shocking. It's definitely a source that you want to start looking at because there are benefits to it. Not just, hey, I get to go out there and do more deals, but the cheap money, being able to combine it with hard money, you're 100% financing a deal without having to come out of pocket cash. Heloc. Who has ever used a Heloc from their primary or rental property to go do a deal? Awesome. Yeah, people don't realize I can leverage a Heloc, use it as working capital, use it as down payment money, use it as rehab costs to go do deals. If we have equity in our primary, let's use it. It's not the first place I would go to fund my deals. I've seen clients where they've had their Heloc called, and now they're scrambling to pay down a Heloc while they're trying to do a deal and it can become a pain in the butt. But it is an option. So if it's there, sitting there, ready to go, we want to have it. Personal loan. Has anybody ever used a personal loan to go fund a deal? Nobody. You've used one? Great. What's great about a personal loan is if I have W-2 income, a lot of real estate investors, they're not out there, they're doing real estate full time. They don't have a W-2 income. If I have a W-2 income, I can leverage my pay stub and my credit to go get $20,000 to $50,000 to be able to use as down payment money. Why wouldn't we do that? If I have no money and I have no cash, but Alpha's going to give me 80 and 100, and I need 20 grand to go put a down payment on a property that I otherwise wouldn't get, why wouldn't we leverage it? It's another tool in our toolbox to make sure that we're getting our deals funded. Cash. Cash is a no-brainer. I love cash. I hoard cash. We should all hoard cash. That's why we have the funding toolbox. We want to use everything before cash. Cash is the easiest thing to spend. It's the hardest thing to get. It's the hardest thing to accumulate. And yet it's the first thing that we spend. We need to start to train ourselves to start to use the other tools in our toolbox so that when shit happens, we still have our cash to be able to spend. Most times when we use our cash first and we go to get a line of credit, we can't, because at that point we've over-leveraged ourselves and we just can't acquire a line of credit or any other resource. So we want to start to change the way we're thinking, change the order of the tools that we're using in our toolbox to make sure that we're keeping ourselves in the best position possible. Private money. Who uses private money? Perfect. Lots of private money lenders out there. I know John does a great talk and presentation on hard money. Go to Kajabi, watch the private money presentation. It's a game changer. It's another tool in the toolbox. And that's the funding toolbox. So it's just to illustrate there's lots of ways to get our deals funded. We need to go out there and get deals funded. Here's the tools to do it. There's other things out there, but most of the clients that I'm working with, if they're using all these, they're in a good position. They're not going to miss out on opportunity. What is unsecured funding? I already touched on this a little bit, but it's a financing option that does not require collateral. So we don't need to pledge assets. We don't need to collateralize a property. I'm not going to use my rental property. As long as my personal credit's positioned well, we can get a line of credit in the business name that we could go use for any general working capital purpose. Think of a personal credit card. It's an unsecured line of credit. It's not secured by anything other than your personal guarantee to pay it back. Obviously, if it's going to report back on our personal credit, we want to make sure that we're paying the credit card off. For real estate investors, the flow of money makes using these tools an added benefit, because whether we're doing a flip or a hold, the flow of money is such that once you use it and deploy it, it's coming back. So as soon as you take money off of a credit card, off of a line of credit, and put it into a deal, and I flip the property, the funds are coming back. Pay the line of credit back down to zero, pay the credit card back down to zero. It's sitting there ready to use for a second, third, fifth, 100th time, ideally. And same thing with a refi. If we're gonna do a refi on the back end, same story. We're putting our funds into a deal, they're coming back on the refi, and they're gonna be used to pay the lines of credit back down to be able to go use again and again and again. It's a no-brainer. So while I'm gonna talk a little bit about MB, I'm trying to educate you a little bit more on options, so don't look at this as a large sales pitch, but it is a little bit of a sales pitch. Who we are, we're your strategist, we're your coach, we're your guide. I am not the direct lender. I work with banks all across the country. So large institutional banks, community banks, credit unions. My goal is to understand what your goals are, not just short term, but long term as well, so that we can create the proper game plan to start accumulating capital in your business to be able to go do more deals. We spend a lot of time with clients making sure that we understand where they are currently, where it is that they want to get to, and figuring out what's in their way so that we can remove that to be able to let them go do what it is that they're looking to do. We aren't, like I said, the lender. We're not the underwriter. We do work with underwriters with a lot of banks. So a lot of times I can get a denial overturned and approved based on what bank we're using anywhere in the country. And again, we're not psychic. So I say that because a lot of people will say to me, hey, I have a 670 credit score. How much capital can you go get me? And I always say the same thing. I like that I hear the credit score, but a credit score is like a snowflake. There's no two credit scores that look alike. So a 670 could look a million different ways. I care more about credit data. How are you positioned? Not so much what the score is. So when we're working with the client, we do need to take a look at credit. We won't guess. We won't go off the score you tell us because most time it's wrong. And we'll spend the time to understand the data so that we're giving you the best options based on how you're currently positioned. And a credit score is a living, breathing thing. As you incur debt and make pay downs, that's going to go up and down. So a credit score is only a snapshot in time from when you look at it. Personal credit positioning. Like I said, 680 FICO. Whenever anybody asks, that's what I say because it's easier than just saying everything that I just said. Typically, we want you around a 680 because we'll know that most of the check boxes will be hit. But typically, what we want to see is an age of file that's at least 5 years old, that minimal inquiries in the past 6 to 12 months. People don't realize how inquiries impact us when we go to get funding, right? If you're thinking about it, if a bank is going to give me money, give me 100 grand, 50 grand, whatever it is, and they're going unsecured, they're not taking any collateral, they're just taking my personal word that I'm going to pay it back, and they see 15 inquiries in the last 6 months, would you lend that person money? No. Because for a lender, they start to wonder what's going on somebody's personal financial life that they're having their credit ran so much that they're looking for so much capital that's not reporting on personal credit anymore. I can't tell you how many times we were about to go get a real estate investor $100,000, $150,000 on a Monday, and over the course of the weekend, they go test driving cars. They have their credit pulled 6, 8, 9, 10 times, not even realizing it. And then Monday morning, we can't go get them, and now we have to wait either 6 months, 9 months, or we got to pay a lot of money to go get those inquiries deleted. So we want to be very cautious having our credit pulled and very conscious about it as well. Who's pulling our credit when, what credit bureau? Let's make sure that we're monitoring these things so that when we need to use our credit, we can, and where we don't find out, oh yeah, shit, I had my credit pulled 8 times in the last month, and now I can't go get funding. No derogatory items, the same thing. Lenders don't want to see questions. Yeah, go ahead, you can ask a quick question.
Hold on, Tom. Hold up for me.
Yeah, you can ask a quick question.
When you say minimal inquiries, what is minimal to you?
So typically I want to see less than 3 or 4 in the last 6 months. So that's minimal. Ideally, if we have 1, 0, better. But anytime we see with the trends with the lenders that we're working with, anytime you have more than 3 or 4, it's typically going to result in a denial. No derogatory items. So no bankruptcies, even there's ways to get around it. No late payments, no unpaid collections, no public records. As they start to age older than 2 years, it starts to free you up a little bit, and there's ways to get around it if need be, but ideally we don't want to see that, and for you guys, you want to make sure that you're not having any of that stuff on there either. Low revolving utilization. What that means is typically we want to see that you're around 30% utilized on your revolving lines. So credit cards, lines of credit in your personal name, let's try and keep them around 30%. You're going to see the biggest drop in credit score when you go from 29% utilized to 31% utilized. There's something about that magic 30% that is a killer. So anytime you're over 30%, get under 30, you'll see a big jump in credit score. And typically before we go for funding, we want to make sure that you're around 30% funding. Building business credit versus building access to cash in your business. There's a big difference there. There's a lot of people that push building business credit. And it's sort of what I talked about earlier. Hey, if you get a DMB score, if you have a pay deck score, we can go out there and get you some revolving lines, some gas cards where you're not the personal guarantor. Awesome, right? That's great. Who doesn't want a gas card that doesn't report in my personal name, and that if I default on it or mess it up won't hurt my personal credit. But at the end of the day, what can we do with that? So I'm all about building access to cash inside of our business. And if you have decent personal credit and those guidelines that I just talked about, and we have an entity that's at least a day old, we can start to build up access to cash. Because as real estate investors, what do we need to go do deals? Access to cash or cash equivalents. So me personally, through multiple LLCs and between leveraging my credit and my wife's credit, has built up almost $600,000 worth of lines of credit. I can self-fund my deals. I love alpha, and if I need to use them, I know Matt's going to take care of me. But for the amount of deals that I'm doing currently, I can self-fund my own deals and put a little bit more money in my pocket. I could also take advantage of opportunities. And I say that a lot, and I become annoying by saying that almost. But people don't realize that opportunities present ourselves while we're taking advantage of another opportunity. Anybody in here have been working on a property that you're gonna flip, and then on that street or in that neighborhood, another property comes on the market that you can get and flip as well? Raise your hands, how many people? Typically, when we're working on an opportunity, another opportunity will find us. So that's why we always say we want to make sure we have access built up so that we can take advantage of it in an instant and not lose out on it. Because I don't know about you guys, but every time I miss out on an opportunity, it kills me. Like I don't even focus on the opportunity I'm working on. I tend to focus on the one that I lost that I should have got. And the more, like a couple months ago, I had a friend that needed a quick $50,000, was willing to pay people crazy money. I lent him the money and made some money on the money that I had off of a line of credit. Why not take a line of credit that I'm, paying 7% interest on, that he's going to, pay me 15% interest on in a point. I gave it to him for a half a point because he's my buddy and I took care of him. But if I didn't have access to that line of credit, I would have missed out on it. Available funding types. So we talk a lot about building business funding, but we also need to build our personal funding as well. Because if we want to start to build up nice approvals, nice access in the business, we have to be positioned a certain way. So there's a lot of times where I'll tell clients that we need to start working on building your personal file to help get us larger approvals, better approvals in the business name. So when we're talking about personal funding, it's an easier application and approval process than the business funding. It's based on your credit profile with some financials. Some lenders ask for tax returns. Some lenders ask for income statements. Most times it's to verify that taxes have been filed, not necessarily to, check on income or revenue. It's just to make sure that there's not a tax lien issue down the line. Business funding, new or existing business, like I said, if you're a day-old business, I can get you funding. As your business starts to age, however, it's almost like little doors start to open. Different types of lines of credit with different lenders, with different banks start to present themselves because now you have a more seasoned LLC. Personal guarantee, most of the unsecured funding will come with a personal guarantee. So that's why when you see a lot of companies pushing no personal guarantee, business lines of credit, most times that's a revolving store card, it's a gas card. Most business lines of credit are gonna come with a personal guarantee, especially as a real estate investor. Like we're in a high risk industry. Banks don't wanna lend to us. So if all we have to do is personally guarantee it, and with the flow of the money and deploying it into a deal and coming off, we shouldn't have a problem paying it back to where personal guarantee is an issue. It's based on personal credit, and typically we can get funding in 10 to 21 days, depending on the line of credit. So that says real estate investor uses. I guess, whatever. So typically what we're seeing real estate investors use the lines of credit for are down payment money, like I said. Alpha has a loan in place for you. You need that 20% plus closing costs, leverage the line of credit. To 100% fund a deal. I love the fact that, I'm buying in Philly, so prices are a little bit different than up here. But if I'm buying a $50,000, $60,000, $70,000 property and I'm gonna put $50,000, $60,000, $70,000 into it, I can fund the whole deal off of a line of credit. It becomes that more efficient for me because I'm using my own money that I built up. So the more that we can do that, the more profitable that we become, the less deals that we actually have to do because we're just keeping more money for ourselves. Rehab money. I know Alpha doesn't have this problem because they're really good about their draw schedules and getting out and inspecting, but I can't tell you about nightmares with real estate investors that can't get a lender out to do a draw schedule, to do an inspection, to release funds for you. They end up, the contractor ends up leaving. By the time they get the funds, they gotta go chase the contractor. Anybody ever have that issue? So use the line of credit to front the rehab. And then at the end, just take one draw from your hard money lender at the end. This way, you keep your contractor at the site, you keep him moving, he's getting paid, your job's getting done, and essentially you're still just leveraging your line of credit, and the funds are all gonna come back anyway when you do the last draw. Or don't take the last draw, sorry, Matt. It is what it is. Holding cost. This is the biggest thing. People forget that you have to pay the hard money lender while you're carrying this loan. People forget that when you have the money deployed off of a line of credit, you have to pay the line of credit. So what I'll have real estate investors do is pull additional funds off the line of credit, put it in the bank account so that they can pay the monthly bill and not have to worry about it. If I have a line of credit in place and I know I got to pay Matt $2,000 a month, my line of credit $1,000 a month, then I'm going to have them pull 12 months worth of payments off the line of credit, put it in the bank account so that they can pay it and not have to worry about coming out of cash flow of their own pocket. It helps them facilitate deals faster, and more than anything, it's a little less cash consuming. Emergency funds, stuff happens. Projects go wrong, contractors quit, deadlines are missed. It's just a good way to make sure that you have access to capital when all those things happen. And then working capital in general, what's great about the lines of credit, they're not deal specific. It's not tied to a property. You don't have to use it only for a deal. I know we were talking to a couple wholesalers earlier today. You can use it to build a buyer's list. You can use it to buy marketing materials. You could use it to buy bandit signs. There's no restrictions on the use of the funds as long as it's legal. So people like to ask, is this something that I can do on my own? Like, can I just go out to banks? Can I just apply for credit cards? Can I just go get these lines of credit myself? And the answer is, well, yes, you can. And I always tell clients, if you only need 10, 15, 20, 30,000, you could spend the time to try and do this yourself. But if the goal is to build up as much access to capital that I can so that I can do more and more deals, we're really the go-to source, because we're going to maximize the amount of funding that we get for you and minimize the impact on personal credit. I can't tell you how many people come to me and they go, listen, I went to Credit Karma and they all said I had an excellent chance of getting approved and I got declined for every single one of them. It's because Credit Karma gets paid for every one of those links when you apply. So a lot of times we can do more with less when we're applying for you. He's not here tonight. If he was, I would point him out because I like making fun of him. He's always in Garwood, but there's an NJRESN member who, when I first met them, him and his wife, the plan was to use both of them to go get lines of credit. And at the last second, he said, you know what, just use my wife. Sure. So we got her $85,000 in lines of credit. About 6 months later, he came back to me, he says, all right, I'm ready. So when I looked at his credit, a funny thing happened. He had applied to every lender that I applied to for his wife. So I said to him, I see you've been out there applying. He's like, and he started laughing. He's like, I don't know how you went and got my wife $85,000. I said, because? He said, because I got 13. Now they had the same credit profile. They were authorized users on each other's cards. They were literally the same file. What he didn't realize was by the time he went to apply, the lenders changed what credit bureau they were pulling. He applied in the wrong order, and he ended up messing up his credit for about 6 to 9 months because he did it the wrong way. So a lot of times when I say, if you need 10, 15, 20,000, you can go do it on your own. But if our goal is to go get 50, 60, 80, $100,000 and minimize the impact on credit, so in 3 to 6 months I can go do it again, we're really like I said, the go-to place to be able to help maximize that. Things to consider. How much funding do you want? How much funding do you want? Like, if I'm only going to go do one deal this year, how much funding do I really want? Do I need 30,000, 50,000, 60,000? How much funding do you need? How can I keep myself in a good position to keep getting funding? How much funding do you qualify for? That's the biggest thing. How am I positioned right now? How much capital can I go get based on what I look like on personal credit, and the age of my business is going to determine that. Where do you get your report? So where do you look at your credit? Do you go to Credit Karma to look at your credit? Do you do a hard inquiry on your credit? Do you look at this Vantage score 1, 2, 3, 4, 5, 8,000? There's a million different credit reporting companies that monitor your credit for you. That's why we care more about the data than the score, because most of the times if you look at 15 different credit reporting places, there are going to be 15 different scores. What score model should I look at? We want to look at a Fico score. A Fico 4 or 8 is commonly what's used in banking. So if we're looking at a Fico score, we know it's accurate. Sometimes you might go on your Credit Karma and you're like, well, I have a 750 credit score. Why is your Fico score say 680? Because Credit Karma uses a different scoring model. Who offers that type of funding? So who offers unsecured funding? Unsecured funding is not a common type of line of credit. What we've done a good job of is building up a database of banks, lenders that actually offer an unsecured product. Spending the time to go out there and find those banks on your own, you're going to spend so much time that you've probably missed 3 or 4 deals in the meantime. So, who offers the type, what type, which credit bureau do they pull? This is a big one. When you go to a lender and they're looking at your credit, which credit bureau do they pull? Most lenders will only pull one credit bureau. And they do that because credit reports are expensive. So they'll pull TransUnion, or they'll pull Experian, or they'll pull Equifax, but they're most likely not going to do a tri-merge because they don't want to pay $30 every time they have somebody come in applying for a line of credit. So we'll sometimes take a client that has a lot of inquiries on TransUnion but not on Experian and create a game plan. We're just going to go to a lender who's going to pull Experian on that given month. Will it create a hard inquiry? Like we talked about, inquiries are important. We want to make sure we're minimizing them. When we're working with a client, we do everything off of a soft pull before we apply to an actual bank so that we don't impact your credit. Some banks will pull a soft inquiry versus a hard. So it's just knowing how to kind of game the system there. How many inquiries do I have? How many inquiries do they allow? Which reports show inquiries? All different things to start to consider when you're starting to look for funding. What types of credit do I have? So this is another big one. What types of credit do I have? We all know about credit cards. We all know about loans. There's other types of credit on our file. Revolving lines, secured lines, unsecured lines. It all plays a part into our credit score and really the way our banks look at us. If you have an auto loan, if you have a credit card, if you have a mortgage, line of credit, you're looked at as a little bit more attractive than somebody who only has one stored credit card. Because people are willing to lend to you, you're lendable in the eyes of other banks. So the more types of capital you can start to build up, the better. So have the auto loan, have the mortgage, have the credit cards, use it. It's only going to help moving forward. What are my utilization ratios? Like we talked about, utilization ratio is a big factor in funding. Like we said, we want to be around 30% utilized, but what goes into the 30%? It's any revolving line, credit cards, lines of credit, in our personal name. And we want to keep it around 30%, like I said. What is my debt to income ratio? This is another one. We don't see the need to monitor this as much in the unsecured space, but if we were going for a personal loan, you're going for a mortgage, you're going for anything like that, debt to income is super important. If you have a debt to income ratio that's high, you're not going to improve for anything. So that's why when I talk with clients and we say, hey, we want to position ourselves so that we have our mortgages in our LLC name and offer personal credit, it's beneficial for you. The more stuff we have on our personal file, the more questions our mortgage broker is going to ask, right, Chris? So the more stuff we can put in the LLC name and off of our personal credit, the better. Yes, our property may be cash flowing, but to have to pull out all the paperwork and give every piece of paperwork is just going to delay the process in getting you funded. How do I access the funds? The lines of credit we're implementing, like I said, checkbook access, you're approved somewhere between $25,000 to $150,000, write a check. If we're doing a credit card model, there's 3 to 5 different strategies to be able to liquidate a credit card into cash. And we do work with that third-party company that will run any invoice and wire funds directly off of a credit card to a lender, to a title company to be able to close on a property. The number one reason for an instant decline, most people who are doing applications on their own, they get denied because they don't complete the application. They'll leave something off. They'll leave a cell phone number off. They'll leave a home number off. They'll leave their email address off for some reason. Whenever a lender sees that you don't complete the application completely, it's an instant denial and people wonder why. So if you're going to go out there and you want to try and get 10, 15, 20,000 applying to lenders, make sure you complete the entire application. Put everything that they ask for on there. It's only going to be more beneficial for you, and then you can go back and explain it if need be. But when they don't see it, it's always an instant denial. So the question is, should I be doing this on my own? And I talked a little bit about the gentleman and his wife and why they shouldn't have done it. The question is really yours. If you only need 10, 20 grand and you want to do one deal a year, you can go out there and do it on your own. But like I said, if the goal is to build up access to capital, do more deals, we help kind of alleviate the pain of going out there and messing up by trial by error. We help you get the access that you need. We allow you to go out there and do more deals. And more than anything, we sell time. For you to go out to these banks and do it all on your own, you're going to spend so much time trying to become the expert that we already are that you've wasted so much time and opportunity that you'll never get that back. So when we're working with a client, it's a simple process. We have an initial meeting where we're trying to understand, like I said, what your goals are, not just short-term, long-term, but then also to make sure that we have a proper understanding of the full picture. Where are you at currently? Where are we trying to get? How can we eliminate that roadblock so that you can go out there and have success? After we have that initial meeting, we're going to take a look at credit. Like I said, we do everything off of a soft pull. So after we take a look at credit, we're going to have a funding consultation where I'm going to lay out exactly what's available to you based on how you're positioned credit-wise and how you're positioned business-wise. I'm going to tell you X amount of dollars, this fast, these are the cost fees associated with putting lines of credit in place, all on that call. And then after that, we take care of all applications. So we work as a concierge service, where we'll handle all the applications. We work with the underwriters. The only time you ever have to really get involved is if you have a lender that needs to verify information. We're just never going to pretend to be you. So we kind of give you a dummy sheet of, you got to call this lender, you got to verify this information, this is what was on the app. Funding fees upon approval. So there's no upfront fees to go through our process. We do charge what we call a success fee. So it's a one-time fee based on the total approval amount that we get you funded for. Depending on the exact type and the line of credit, it's a one-time fee, anywhere from 6 to 9%. Now you may hear that and say, wow, 6 to 9%, that's high. But it's a one-time fee for permanent funding. All these lines of credit that we put in place for you, they're not going to go anywhere as long as you use them responsibly. So think of every time I leverage the funds, the cost of acquisition becomes less and less each time because I don't have to pay for it each and every time that I pull the money out. So like my lines of credit that I've used probably 100 different times has essentially cost me nothing because of the compounding factor of not having to pay each and every time. So the more access I can build, the more times I can turn it, leverage it, use it, the less the cost of acquisition becomes for you, to the point where you become your own banker and can start to fund more deals by yourself without the help of Matt over there. This is our team. That's all of us, nothing to really go in there. If you go on Facebook tonight, anybody who likes MB Capital tonight will get entered into a raffle later this week. We're going to do a drawing where the winner that we pull out will get a $25 Amazon gift card sent to you. So jump on Facebook, search MB Capital Solutions, give us a like. We're going to throw your name into a hat. We're going to pull out a name. We're going to send you a $25 gift card. So go like MB Capital tonight and your chance to win. So that's pretty much everything I want to go over tonight. Thank you, I appreciate it. What we're going to do now, any questions? We have a good amount of time here to be able to kind of answer any questions that you have, kind of point you in the right direction. So I know we're going to go around, deliver the mic to anybody who may have some questions. So anything anybody has.
Thanks, Nick. That was really good. Anybody here have questions? Hello? All right, good. Who was up? Tom again? All right. Let me get Vic, right? Yeah. Okay.
Thank you. A quick question, Nick. You said 30% on the revolving credit. Can you just dive in? What is included in revolving credit? Is it credit cards?
So your credit cards, any revolving lines whatsoever. So no loans, no auto loans, no personal loans are included in your revolving utilization.
What about mortgages?
No.
No mortgage. So it's pretty much like your Macy's card or your Bank
Your
of
Macy's
America
card, your credit cards, store cards, gas cards, any revolving lines of credit that you may have. You may have a $5,000 line of credit that you got from your bank when you signed up, something like that. The utilization of those lines do matter.
Okay. So it's basically don't go over the 30% mark in terms of utilization.
Ideally, we want to stay under 30% at all times. There's going to be times where we're using our personal credit. I mean, I see it all the time with real estate investors. They don't know about business funding, so they leverage personal money, and they end up shitting the bed credit-wise because they're just overutilized. And they're always on that kind of roller coaster as they're doing deals. So I do a deal, I pay my lines back, the score goes up, but then I pull on the money again to go do more deals, and now my score goes back down. What we're trying to do is position you to be able to take advantage of more opportunity by making sure personal credit's always clean and just leverage the crap out of the business money.
30% rule is very, very important. You know, you could have a $100,000 line on a credit card, and if you stay under that 30%, but you always have a $20,000, $25,000 balance, and you just keep paying that, you're going to be fine. It's when your total usage, especially from when you're going for a mortgage, you will see a drop in your score with the higher that your debt utilization. Now, any credit cards, mortgage companies, what Nick does and the banks that he's working with, they want to see that you're able to repay. This went off again. They want to see that you're able to repay. Okay, so they like credit, but overutilization of that 30%, that's really the sweet spot where you want to stay under to keep your score high and show that you have an ability to repay.
And in the credit score algorithm, there's something about 31%. Anytime you hit that, you see a drop in credit score. So we always want to be 30 or under. Ideally, if we could be in the 10 to 20% range, it's ideal.
Absolutely.
What's up, Bob?
So Nick, you're talking about that 30%.
Yep.
But you do rebound if you pay it all off. So you do a deal,
Correct.
you get it all paid off. That score, it doesn't take 6 months for you to be back in good standing, right?
No, so it all depends. So say we have a Chase card. I have a $50,000 balance on it. I need to get under 30% utilized. I pay it off today. It doesn't mean that tomorrow, if I run my credit, that now all of a sudden my credit score is going to be up. Depends on when the line actually reports to the credit bureaus.
And
So-
typically, would that be a month?
It's
thing?
within 30 days. So
45 days. on
yes.
our side, we see it.
So when you pay it off, depending on when the reporting date actually is when you'll actually see the difference in the credit score after you make the pay down.
All right, and last question I had, you talked about these inquiries. Did I hear you say that you do it once and that will carry for the year?
That's for alpha funding. So alpha funding, what's great about alpha, especially as we're trying to build capital for you, if they're only going to pull their credit once a year, you're approved for a year when they do a hard inquiry on your file. For us, when we start funding, we want to make sure that you're under 3. So to have a lender who's not going to pull your credit 3, 4, 5 times in the course of 30 days, it's beneficial.
Not really a question. I just want to give a testimonial. Nick just helped me a couple weeks ago. And I was kind of snobby because I worked in banking for 7 years and I thought I knew everything about credit and applying. And he was able to shed a lot of light to me even about, the process of going through it. One thing that was extremely beneficial, even with that 30% mark, he looked at everything with me first, didn't do a hard hit, told me what I needed to do in place before I should apply, and then even knew the exact day that will actually report, so I didn't apply beforehand and maybe get rejected, and it was able to get me, I think, about $65,000 in credit.
And you still
which is
have a
low
pending
rate
app
for-
or two.
Yeah. So,
doing good.
thank you. Just wanted to share that with everybody.
Thanks, guys. Thanks, Rob.
Hey, Nick, couple of things you mentioned earlier. What was the name of the process you said to get to 50 properties? You said
The BRRRR model. The BRRRR model. So BRRRR, like it's cold, but it's not B-U-R-R. It's B-R-R-R. So the B is buy it. You got to acquire the property. The R is rehab. So we want to buy undervalued properties that we can fix up, add value to. The second R is rent it out. Let's get a tenant in there or make it rent ready. The next R is refi. So for me personally, when I'm looking at numbers on properties, I want to make sure that my all-in cost is about 75% of the ARV because I know in the back end, I'm going to do a refinance and pull out 75%. So I know if I can pull every dollar out that I put into a deal, that's a win for me. And then the last R is repeat because I'm going to pull that money out and go do it again and again and again. So essentially I can leverage my line of credit, hard money, whatever my funding toolbox to be able to keep acquiring properties using the same funds. It's the BRRRR model. You can look it up on Bigger Pockets. It's become more and more of a, go ahead.
Oh, you said, what was it, Bigger Pockets, you said?
Bigger Pockets,
Bigger
yeah.
Pockets.
They do a good job explaining the BRRRR model. The key to the BRRRR model is to have access to capital and then have resources, which are all in this room, to be able to make that happen. So if you have a line of credit, we have cash, and we can leverage hard money to get into a deal. And then on the back end, you go to somebody like Chris who can refinance you out of the hard money loan and give you the cash out to be able to pay your line of credit back. And now you have a tenant who's paying your mortgage and the property's cash flowing, and I don't have a dollar into the deal. That's a deal I'll do every day.
So thanks a lot for that. One other thing, you said, what was the private money video to watch?
John Steingraber does a great presentation on raising private money.
Oh,
Yeah, are you a member of NJRESN?
No, I talked to Kristen, though. She said they're changed some things, so we'll talk tomorrow.
Okay.
Yeah.
Yeah, when you sign up, you'll get access to Kajabi. It will have all the videos right there.
Okay.
You definitely want to check them out.
Quite some time too. So you can see
It's a place to go for knowledge, for
Anyone
sure.
else? I got a question.
Hi, when we talk about the 30%, just one question. If you have multiple credit cards, say 40, 30, and 30, let's make it 100K. And so suppose out of the 40K credit card, can I pull like say 30,000, still I'm at the 30 ratio? That will
Yes.
do?
We want overall utilization to be at 30%. Ideally, if we can, let's try and keep every line at 30%. But if you have to pull on one line because we need to, as long as we keep overall utilization around 30%, we're going to be okay.
One question on the Heloc. If we pull say on the primary home, if somebody has a Heloc and if pulls out all the money, will it impact the credit? There is 30% rule or anything on the Heloc?
No, the HELOC is not included in the 30% utilization. However, when you pull the whole HELOC, you will see a couple point drop because you're using 100% of the line.
When you talk about the Heloc, in general, the bank says like Heloc goes up to 80% of the ARV in a way.
Of the value of the
Of
property.
the
that
value
you're
of the
pulling
property.
off.
Some bank goes up to 100% also. Do you have any experience with the bank which goes more than 100%, and if you pull the full Heloc, it's like 80% is already loan, like first primary lien, the
Right.
Heloc is the rest of the things, and if you pull full things, what is the impact on the credit?
So, I don't work with any banks that are doing 100% on a HELOC. Most of the lenders that I'm seeing doing a secured line of credit, they're going 70, 80 max. For them, it's just not worth the risk if you mess up using the money. Now they got to come take your home. They don't want to take the home. They don't want to be in second position. They don't want to wait for you to sell the property. So they're going to give you up to that 80% of the LTV. And then what was the second part of your question?
So if some banks, like I'll give the example for the benefit of the room, like if you have a TD as a primary on your primary resident, they give the 90% of the Heloc, not the 80. They go extra 10%, but their condition is there should be primary on the first lien as such. And there are some DCU also, which goes up to 100%, although they are not the primary also. So there are way outs of there, but still experimenting on that. My question is this, that if I go with the TD or say any DCU bank which gives 90 or 100% of the Heloc, and if I pull full or maybe say
Full on.
50% of that, will it impact my credit?
No.
Should not.
No, should not impact credit.
And just feedback, I used Eric almost 2.5 years back. I got almost 5-6 credit cards and one line of credit. The beauty of this is that we should not miss that what the fees we are paying is for the life of that credit card, which is like till you close it. And the best part about it is like some of the bank come up and increase your credit on their own, and they send you letter if you want more credit card, we'll let you do that. So it's a one-time thing, but the benefit it goes for the life as such. Just a feedback on the experience.
And just so you know, with our funding fees, what's included in that is us. Like, we don't just get you funding, tap you on the tush, and say, get out there. Like, we're here as like a financial advisor for credit and capital moving forward. So you need something, we need to make maneuvers, we're here as a resource. And like, what he was saying about, they'll increase the lines of credit as you're using them. For what we're using them for, and we're deploying money into a deal and paying it back down, when banks see that and credit card companies see that, and they want to give you more money because they want you to go use it, because their hope is that at some point you're not going to be able to pay it back right away, so that they can keep getting interest on it. And when we're doing a credit card plan, the 0% from anywhere from a year to 2 years is great. The key to really maximizing that model is making sure we are paying it down at some point so that the banks give you another 0% promotion. So it's not keep accumulating credit cards at 0%, because with banks, if we pay the money back before the promotion expires, they want to give you another promotion for two reasons. One, they want to hold your debt. It looks good on their balance sheets. And two, the stats show that 89% of the people that use 0% promotions, they end up fucking it up. So they're hoping that you're going to fuck it up and that they're going to get you. So we show our clients how to be a part of the 11% that know how to utilize the credit cards, utilize the lines of credit, go out there maximizing it, and minimize the actual percentage of interest that we're paying. The 200 and I think it's 260 now that I'm leveraging in my business, would say 60% of it's on 0% credit cards, or the rest are on traditional lines of credit. I'm using that debt right now, leverage, at a blended rate of 4.88%. Where else can I go borrow money at 4.88% on a line of credit right now? You can't, it's under prime. So being able to use this in combination is really, it's a good tool to get out there and get cheap money and be able to do more deals.
Does everyone understand that with blended rate? Does everyone understand blended margin right there? Right? He's borrowing one at 0 and maybe the other at, I don't know,
7,
6
8,
or
9.
7 or 8 or whatever. So his total all-in his total all-in interest that he's paying on the money comes out to 4.88. That's pretty fantastic.
You name a bank that I can go get it, and I'll go apply for that.
Absolutely.
Like, you can't get it. So the more that we can build up, the more 0% offers
We're used to
we
giving
get.
out 10% on the money on private, right? Is that the going rate? Maybe avoid the points, but you're still paying 10% of the money. Some
I-
people are still giving out more.
Yeah, I've built up my own access. I'm using 250,000, 260 at 4.88%. I can't
it's
borrow that
pretty-
money anywhere,
That's pretty good.
anywhere.
Any other questions? Let me see if I can get somebody else that hasn't gone. Any other questions? Here you go. Robert.
How are the fees paid?
So you pay us after you actually have access to the funds. So there's no upfront payments. A lot of times what we could do is help you facilitate it to the new line, especially if we're doing a 0% credit card plan, so that essentially you're not coming out of pocket cash. We're going to put it onto a 0% credit card. The best part about 0% credit cards is when we're carrying debt on 0% credit cards, our minimum monthly payment is 1% of the balance. So if I have a $50,000 credit card that I'm using and leveraging at 0%, my minimum monthly payment on it is $500. So like, as I start to acquire capital, like recently, I just had another 0% offer come in. I took one of the balance convenience checks, wrote myself out a check for $30,000, put it in the bank account. If I use it in the next year, great. If not, I'll pay it back. I've paid no interest on it. I literally pay the $300 that I took off of the 30 grand off of the credit card out of the checking account that I put the 30 grand into. So I'm not really paying anything on it. I'm not taking any, hit anywhere. I have access to cash if I need it, and it's cheap money.
Nick, on that scenario,
Yeah.
like, because we all get those credit cards in the mail, those offers and promotions.
Yep.
That you'll have, 0% and there's a one-time 3%.
Yeah.
Or a minimum of X amount of dollars. It's either whichever is greater.
Yep.
So on that particular scenario, is there a 3%,
Depending on the lender and the promotion, yes, sometimes there's a 3% fee.
There's a 3% fee to transfer the balance to a 0% credit card.
Correct.
Or a 0% promotion that you're going to
Right.
have for 18 months at 0%, but you pay 3% out the gate.
Correct.
On that total transfer balance, right? Everyone
Yeah.
understand that?
Some lenders, if you do it within the first 15 days, 30 days, 60 days, they'll waive it. So that's why it's important to pay attention as you're getting 0% offers on your personal cards, even on the business cards, that you're paying attention to the promotion. For me, I'll pay the 3%
Yeah, I
on
would
the
do
30
the same-
grand.
I would do the same thing.
I mean, I'm going to carry it for 0% from anywhere for a year to 2
100%.
years.
Yep.
It's a no-brainer.
Anyone else? Tom?
Hey, Nick, I had a question about,
Sure.
you get a credit card, right?
Yep.
It's a $10,000 line of credit, for example. And you could go charge something with a vendor for $10,000. But to get a cash advance, can you get that 10, or is it usually less than the line of credit?
So you just said some very dirty words. Cash advance. Never, ever, ever do a cash advance on a credit card. Anytime you do a cash advance, you're going to be paying 20, 30, 40% interest on the cash advance.
Okay, so how are you accessing that $10,000?
So we can do invoicing models. We could do the balance transfer checks. There's a couple strategic ways that we show our clients. I like the third-party company that allows you to pay any invoice using a 0% credit card. That way we can wire funds directly to title company for a closing. If I have to pay my contractor and he's giving me an invoice, I'll run it on a 0% credit card. There's lots of different ways to actually liquidate the cash. We're never, ever going to do a cash advance.
Really writing that check then that you just talked about?
Through the third-party company, they're writing the check. So you get set up with an online dashboard, you put your invoice in, they cut the check on your behalf. So that's what they do in terms of the ACH payment, they'll cut a check on your behalf.
You got the 0%.
Yep.
You immediately wrote a check.
Yeah, when I got the offer, it came with a blank check. Yeah, it came as a blank check. So you may even get them, you don't even realize them. They're convenience checks, they're balance transfer checks. You could use those to access cash as not a cash advance. You may pay the 3% fee, you may pay a $25 fee, But if I can take a check that I have a $20,000 line of credit on a credit card and write out a check for 20 grand and put it in my bank account and carry that for 9, 12, 15 months at 0%,
I had
that's
an
not a cash advance.
I had an $18,000 balance on a credit card. I did a 0%. I got something in the mail on another credit card that has zero balance. I had a 0% interest for introductory rate for 18 months. Came with 3 checks in the mail. I was like, all right, so I read the T's and C's. It turned out to be legit. I wrote a check to the credit card company for 18 grand, and I basically paid that bill, and it just transferred the balance. It was a balance transfer, but it wasn't a balance transfer. I paid it like I was writing a check.
Right, you
And
could maneuver debt.
it's
So I'll have clients
transferring
where,
paper.
yeah, I'll have clients where we'll take a lot, they're paying a lot of high interest on credit cards, and we'll, move it over to a 0%, credit card, where now, they went from paying $8,000, $9,000 on credit card debt, and now they transferred all that debt into 0% cards, and now they're paying $100, $200.
100%. If anybody's not doing that out the gate and they're paying interest on their credit cards, you should
Stop.
be looking at that immediately. That was the number one thing that helped me get out of debt out of college. Okay, because you get out of college, you use your card, it all starts to be compounding interest, right? The number one way to get out of there is to just keep pushing out that 0%. If you pay the 3% VIG, whatever, it's 3%, but then you're just going to keep pushing out a 0%, and eventually you will get out of debt if you're disciplined enough to pay it off, or just find another 18% or 15. If you go on creditcard.com for that type of model, and I don't want to take away from what Nick does because there's a serious value add, but it could help you out in a small way of just pushing out a 0% balance.
Totally.
If you're paying 12%, 18%, 20%, just a very easy way to get out of it. You can open up 2 cards and you can split the balances there if you don't get that high of a line. But you should not be paying anything more than what or just be disciplined enough to pay off the card in full, which most of us don't have that wherewithal to do.
Yeah.
But the
And,
0% model is a great way to do it.
Another point before, Fortune Builder students, we pay a ton of money in tuition. Where do we put it? Put it on credit cards, right? How many of those credit cards are at 0%? I talk to Fortune Builder students across the country. Most of them are not. Now I have $50,000 for the mastery program that I'm paying $1,400, $1,800, $2,400 a month in credit card debt. If I can move that 50 grand to a 0% card and now I'm paying $500 a month, from a cash flow perspective, how much of an impact is that for you? Huge. I can still pay the 2 grand, I'm just paying down the principal faster, or if I have cash flow concerns, I've now alleviated $1,500 worth of monthly payments.
Yeah, 100%.
So I have a question as to how do you manage all that? Because I mean,
Mm-hmm.
it must be like confusing to have multiple credit cards, how much interest, when you have to pay what. So do you guys also provide recommendations, a system or something, how to track
We provide what's called a CCM sheet, credit card management sheet. So everything's all in one spot for personal and for business. I have it separated and we do it for all of our clients. So any credit cards, lines of credit that you even have in place that we didn't implement or anything like that is all on one tab. It'll have all the notes, it will have the available balance, what the limits are, when the expiration becomes, so that if we jump on a call and you're like, hey, I have a 0% offer that's gonna expire in 2 months, we can look at your full marketplace of availability and know where we need to move it or pay it off. I leverage, between me and my wife, probably 47 different lines. That credit card management sheet, I probably spend 12 minutes a month on. Makes it pretty
And then
easy.
what, you put like reminders in your calendar when to pay what or when to do?
I pay everything on auto pay. So all my lines of credit, I have,
Oh, you have it all.
I have it on auto pay. So I know every month I need X amount of dollars in the checking account. Auto pay will take care of the rest of it.
Just out of curiosity, how many people here actually do self audits? They know their what their balances, their outstanding balances, and what money's going out and what money's coming in on a regular basis. Like legit, be honest with yourselves here and don't be offended or embarrassed if you're not doing it. But how many people are doing self audits, monthly self audits?
Yeah, most people don't.
Most people don't.
Yeah.
Bob, we know you do. Bob's an accountant if anyone doesn't know Bob.
Yeah, any client that we work with, we give them a CCM sheet where you see everything in one place, makes it nice and easy to manage going forward.
Nick, one more question. You
Sure.
talked about inquiries to your credit report, how
Mhm.
you should keep them down to a minimum.
Yep.
A lot of the companies, TransUnion, Equifax, Experian, are now offering the option to lock your credit.
Yeah.
When you lock your credit, do you prevent unwanted pulls?
I mean, you do. When you're doing a credit lock, You know, some companies will do soft pulls on you without you knowing. That's how you get those pre-screened mailers where you're like, how did I get approved for a credit card or pre-approved for a credit card? When you're locking your credit, you're making sure that nobody can look even on a soft pull at your credit. So if there's any hard inquiries that are hitting your credit without your knowledge, then you got a different issue going on.
Right.
Yeah.
I'm saying that, so even if, once you do a lock, that soft or hard basically just get eliminated completely.
Correct. Until you actually need to go have your credit pulled, and then you got to give permission. Yeah, unfreeze it.
Any other questions, guys? Some pretty awesome stuff here. I think it's kind of actually, I'm surprised that the room is not more full. Another question, sir?
I don't know if this is for offline conversation. At the beginning, you mentioned NCH. Is that important to this, or that's something that's completely
So
different?
NCH is a company that works with Fortune Builder students to help build up business credit. They're a little bit different than what we do at MB Capital, where they're focusing on building a paydex score and acquiring vendor lines and, you know, getting you in a position where you have a high paydex score. We're focusing on cash access.
Got it. Okay. Thanks.
Anyone else? Pretty awesome stuff, though. All right, guys, let's give it up for Nick.
Thank you very much.